a.m. Eastern Time. Let's get started for a little weekly outlook and kickoff, a little opening bell action. It's 9:30, markets open. We had a little bit of a gap to the upside, 396 with a close last week Friday around 395. I just wanted to get into the charts here this morning. Let's talk about a couple of important things with the big decision the market has to make. We have one more week of trading until we have the Fed next Wednesday to kick off a little rate hike cycle. Sounds like the ECB is following suit as well. So we'll talk about that all this morning in the session. So let's get into the risk disclaimer. We understand risk in trading. Please and always use trade capital only. Do not trade with money you cannot afford to lose, whether you trade stocks, options, futures, forex, cryptos, you know the risks. If you're following me on social media, best place to follow me is here, Mondays and Fridays on YouTube, youtube.com/Chris Pulver. Also on Twitter at @RealChrisPulver. I'm verified now. Oh boy. Have that old blue check mark, so you know it's me. Speaking of non-verified, if you see any misspellings or weird solicitations and something that sounds a little shady, it's probably a scammer. Make sure you kick those people off social media. Just follow me on YouTube, follow me on Twitter. Best place to find me. All right, let's get into the charts. This is the decision that I wanted to talk about. This is the SPX, so following the S&P 500. What is important? Well, take a look at this. This was a CPI point. This was a CPI point. This was a CPI point. Crazy, right? So I think it was the September CPI in October put in this market low. We had the CPI in December that was retesting the highs. Then we had the CPI in January that was retesting. So basically, the market's got to make a decision. The last couple weeks, I said if we're not below 380, then we don't trade bearish. If we're not above 410, we don't trade bullish. All right. But the fact of the matter is the market is kind of stuck and coiling in this area. It wouldn't surprise me that if and when we get a breakout, we follow along. So I'm looking for price to make a break up here, make a break down here. And wherever it decides to go, I'm looking to follow. Okay. Just in the back of your mind, keep the potential like bull trap, bear trap scenario, as well. I mean, this is what happens. What's a bull trap? If the market breaks up here, right? Market breaks up here, but can't sustain the close above here and then starts to rip back down. That's a bull trap. What's a bear trap? If the bears close down here, but they can't sustain the close and it reverses back up, right? I still think anything inside 380 to 410 is potentially a messy zone, but just given this high, this low, this high, even this high here, this low, and this high. It's been a fairly obedient corrective move. So we're either looking to break higher or looking to break lower, and there will be money to be made in either direction. So if you're looking for a play in the S&P, the broader market, I mean, it's not going to be everything is awesome and ripping to the upside or downside. I'm not sure how much lower tech can go necessarily, but NASDAQ has outperformed the Dow Jones the last couple of weeks by a decent margin. If we go into the sectors for the year, we go to sector performance and tracker. I want to go year to date. Let's do tools, tracker, and let's go year to date. There you go. So last year, right? Last year it was all energy. Energy was up like 60% for the year. What's leading the way this year? Year to date, communication services. XLC is the sector. If anybody's looked at, Verizon or AT&T, I'm sorry, communicate. I was like discretionary. I saw Carnival Cruise Lines, which I'm in, but I'm like, that's not communication. Here you go. Warner Brothers, Paramount, Walt Disney, Charter Communications, Netflix, and communications. Interesting. Netflix has had a pretty good recovery. 175 to 180 lows, all the way back to 330 plus. I did lose Netflix last Friday for about $30 a share, which I'm pretty happy with. Meta's considered communication. That's made a nice little comeback. Credit spreads were closed out. Made some good profit on Meta and Netflix. Comcast has had a pretty good turnaround. Google, AT&T, right? So anyway, leading the way by a pretty healthy margin, 10.65%. What's interesting is consumer staples is down. A lot of that was last week. We had these big dips. I mean, Keurig Dr. Pepper we were tracking in equities on demand. KHC, I did lose it last week for profit at $37.50 for like $4 a share. I'm going to try to go in. Actually, I can do that right now and get it covered. KHC is sitting at 40.16. I'm going to cover it at $40 on my Schwab account and probably do a $40, $50, or $41 on my other account. But I had it called away around $37.50 for a few bucks. And I'll put a chart alarm below this low around $39.25. If this is a buy the dip scenario, that's great. I don't think there are earnings on KHC anytime soon, or maybe within the next couple of weeks, but let's double check that. I thought it was in February. Kraft Heinz right there. Earnings February 15th. And last reported earnings from Q4 were positive. We just had a big dip. So technically, if I go back to the charts, this is what I'm looking for. You know, we have some pretty solid resistance around 45, and then we have levels that I would really like to buy more and accumulate more around 35. So 45 to 35, nice little range trade on KHC. Trying to get it called away, you know, for profit in here as we near those highs. I will accumulate more with some additional option trades near the lows around 35. So that's KHC, Keurig Dr. Pepper, KDP. Another one we've been trading at 34.59. Some pretty strong support in the low 30s, $33 to $32. Pretty strong support on KDP. You take a look at Coca-Cola, a little bit more expensive, but still, if we have some support sitting around $54, we have resistance up here around $66. You know, there's some opportunities in the middle if we see a risk on rally, but otherwise I would just wait and see if we can buy a little bit lower, a little bit cheaper. PepsiCo, same thing, pretty similar. I think it's PEP, Pepsi. Yep, PEP. Nice little channel here, right? So we're seeing higher lows, higher highs. Not a bad spot to look for a scoop, but stock's obviously a little bit more expensive. So more option plays, no assignment. I'm probably not going to hold any PepsiCo. So anyway, all right, let me log into YouTube. Say hi, everybody. Happy Monday. All that good stuff. All right. So logged in. Denise first in the chat today. Good morning, Denise. Mike, good morning. David, good morning. Chris, good morning. And good morning. Bill, what's happening? Ranjit, good morning. Scott's here. Raz here. Daniel's here. Let's see here. Tom in the house. Steve in the house. Jason, Craig, Gary, K, good morning. Alcoa and dollar yen. That's all good, man. We had a nice little joke about that on Friday. Moch, good morning. Greg, good morning. Catherine, good morning. Tom, what's up, Tom? Matt, good morning. Jacob, good morning. All right, good. Nice to see everybody. Okay, so we were just talking about some consumer staples, you know, getting hit pretty hard over the last week or so, but checking the sector tracker, communication services is up. You know, for me personally, yes, I've generated some profits on Meta. Netflix has been nice recoveries. Disney's doing fine with some, you know, buy and hold. I do have some Warner Brothers, but my big focus for communication services was looking at something like AT&T and Verizon to come back. You know, people have cell phones. It's ridiculous, right? I mean, you're gonna pay your phone bill probably. I don't know. I think there's a weird, twisted survey that goes out saying what would you rather keep? It's like people would rather keep their cell phone than their, I don't know, heat their house. I'm joking, but maybe I'm not. Anyway, but communication services is leading the way this year to date. So we're only, you know, a couple weeks into trading, but pretty interesting jump start. Consumer discretionary is up as well. Staples down, which I thought was interesting, but a lot of that was a big drop last week. Healthcare, keep seeing a lot of forecasts of healthcare doing well this year. Healthcare is pretty expensive, but I know that, you know, we just shorted Johnson & Johnson over the last week or two and took some profit on that. Materials, still like materials quite a bit. Steel, aluminum, Alcoa's been doing well. Let's see, CLF, Cleveland Cliffs, and United States Steel doing pretty well. FCX has been a copper play that's done great. Some real estate activity. Have some Pulte Homes. We've had Toll Brothers and KB Homes in the past. We traded Lennar. Those have all put in some nice bottoms since last year. Technology's making a nice little comeback, but I'd say this is short-lived. I'm still in a higher rate environment. I'm enjoying the fact that NASDAQ's recovered and that technology is recovering, but I don't think this is necessarily full-on recovery. We're a long ways off those highs from 2021, and I think that, you know, it's a nice short-term rally if you timed it well, but I would not want to be stuck holding a bunch of technology moving into this year. So back to the charts really quickly, and then we'll look at a little bit of Forex as well. But I just said this morning, the S&P is at a very critical decision point. Okay, we had a CPI data point here that put in a low. We had a CPI data point here that put in a high, and a CPI data point here that put in a high. Now, the market can obviously break these highs, or it can come back and challenge these lows. I don't know what the market's going to do, but these are the two areas I'm watching. This is either a technical breaking point to the upside, or this is a technical rejection point based on this channel to the downside. And like I said, just be, potentially thinking as a backup plan, there could be a bull trap or bear trap waiting. So 410 to the upside. If we break above it, I'm looking to follow that momentum up. 380 and 375 to the downside if we break lower. Right? Fed's likely going to raise rates 25 basis points next Wednesday, February 1st. And I just read this morning that the ECB is likely going to raise rates by 50 basis points in February and in March. So took a look at the currency strength chart this morning. Vertical axis-wise, JPY is a little bit softer. Things are kind of bundled up here in the middle. But Aussie, dollar, euro on top. CAD is just off baseline. New Zealand's pretty neutral. I did take one of my positions off. I had New Zealand, Swiss. My yearly pivot's been hit. I was up about 90 pips or so. I just took some profit. I'm looking to scale back in. There's potential head and shoulders. I like some of these big setups on the Swiss pairs. Euro Swiss is back above parity again, which I'm pretty happy with. So I'm going to see if we can reclaim those highs around 1.01, or we're trading at 1.0020. So this was an interesting little fake out last week. This big drop got scooped up, and by Friday we were closing right back above some trend areas. We look at it this way, possibly a nice little channel on the Euro Swiss. So if we head up here, score a point for those bulls around 1.01 and change. I am curious if we can come back into this area here between 102.50 to 103.50. My big destination would be around 105. If I can get it, that'd be fantastic. But I'll be watching for profits here really closely on the Euro Swiss. Okay, what about some other stuff? Some other currencies. Anything else that looks interesting? Aussie CAD. I know I have to go here in about 10 to 15 minutes to start my equities on demand class. Aussie CAD would book some profit at the highs. Aussie Swiss, nice little recovery. Again, potential crown pattern to the upside. So just going to look at some solid directional plays. So, left tip, center tip, right tip with that little U-turn. If we can break above that yearly pivot, which is around 6,500, we have room on the Aussie Swiss to come back to these highs, come back into this nice little supply zone between 67 and 68. That could be a pretty simple measured move as well. If we have a low to high, I already have a fib drawn. There's a 127, 618 extension right in here. Plus that pocket, we could have a 5-wave move, wave 1, wave 2, wave 3, wave 4, wave 5, something like that. Just depends how it plays out. But I like anything at 6,700 or higher for profit on Aussie Swiss. Aussie yen crosses, I'm just staying out of. I mean, and maybe I'm missing out on day-to-day volatility. I clearly am. I mean, we've seen, last week we probably had the Japanese yen. This was Friday last week. If I could go back and show you the rest of the week, I know that we had super weak Japanese yen. We had super strong Japanese yen. We had the BOJ economic outlook and policy statement. It's just a very volatile currency pair right now. And I think the market's trying to consistently make a decision based on what the BOJ is going to do, but it's tough to see it. So I think if you're trading intraday or trading through the week, get some nice short-term volatility in the JPY crosses, but I don't really want to position trade JPY crosses. The only position I like, truthfully, would be this dollar yen, and it's not now. I know we have some traders that are interested in buying. It came back to that 50% zone, but I'm more interested in this 118, this 118 to 115 zone, breaking the trend line, then looking for more of a position trade. Otherwise, if we're on the left-hand side of the trend line, this heads up. If this heads down for the rest of the week, you're going to continue to see, today's weak yen, tomorrow maybe strong yen. So it's a very flighty currency at the moment. Okay, good. Watchdog says Euro Swiss grab profit this morning, 250 pips on 3 positions. Fantastic. MNQ for futures trading. MNQ. So E-mini NASDAQ. Yeah. I still see a sell zone, right? I see there's some relief room. We have a yearly pivot, but we've had every time we've come back into this 200 EMA, which is where I think we're possibly showing a recovery. I say there's with the absence of the Fed for the next week and a half, right until February 1st, depending on how firm they're going to stay on their language, I could still see this short-term recovery for the first few weeks of the year. We have the 200 EMA that we've had closes above, right? So there's a little relief rally, kind of reversion to the mean. We come back to that 200 EMA, great. Congratulations, bulls. You made a nice little recovery off these lows. But if we have a close above, close below, close above, close below, close above, close below, I would just be aware of that. I mean, if anything, we're probably going to build some longer wedge and coil. I just don't think that tech is going to make this huge recovery. I think that having this back down one more time, connect the lows this way, connect the highs. We have this, kind of depressing move to the downside. But the tighter and tighter it gets, then we build a basis more sideways. This would just be the reality of like carving out a low. I mean, I think that 2023 is not necessarily a V bottom type year, right? We don't have stimulus. We don't have this cash bazooka. Certainly not going into the markets like it was in 2020. So I think the cheap money cycle is done for now. The U.S. is getting hammered with this debt ceiling debate that could be a real heated topic by summer. So anyway, it's just that's what I see. EMA is right here at 12,176. Yearly pivot's a little bit higher, but if we close above, close below, I think that's the reversion. And then look for that to close back below. I'd expect it to be tougher sledding for the NASDAQ in general. Okay, good stuff. Pound US dollar. Okay, Scott, take a look at that. Pound US dollar. I said this last couple weeks. Watch out for this resistance right here. Equal highs around 2,400, and so far that's playing out pretty well. So I could see the pound dollar kind of ranging up here near the highs, having to make some type of decision. There's going to be, we know that the Fed is going to raise rates. I'm not sure what the BOE has planned. Inflation-wise, things have been coming down, but inflation in the UK is way higher. I think the last CPI print they had year over year was over 10%. If I go inflation by country, inflation rate by country, and I just sort through, I'll go G20s here and sort by the last print. The UK sitting, previous was 10.7 and the last print was 10.5. There's still a lot of Eurozone, UK Eurozone base inflation. Germany from 10 to 8.6, Euro area 10.1 to 9.2. But these high levels of very sticky inflation plus energy, energy crisis with Russia Ukraine still a thing. It's not going away. But the energy crunch being felt, we just have high inflation. The U.S. keeps coming down. We were at peak around 9.1 year over year, and have come down to 6.5. But if the Fed is still very much after the 2% inflation target, they're essentially going to have to push for like 0% inflation. And maybe we overshoot it. Maybe we actually experience deflation, and then we spike right back up to that 3, 4, 5%. So it's going to be. I think this is going to be a perpetual problem. I think in the inflation issue that we have right now is probably going to last the next 2, 3, 5 years, where we can maybe suppress it, get it down into low levels, or we might overshoot to kind of balance it in acceptable areas. But I think it's easy for inflation to spike up and rear its head to the 4, 5, 6% zone. It's just going to be one thing I'm watching is what are the fixed income vehicles? Can you park your money in a U.S. Treasury bond or Treasury note and actually make 3, 4%? And is that enough to combat inflation? I'm curious what the old Treasury inflation protection securities look like. The TIPS stuff I had to know for the Series 65. They're inflation adjusted, so I feel like some of the biggest adjustments we've seen have been the last couple of years on those Treasury bonds. So anyway, but look, inflation's not going away. Okay, Eurozone, especially Bank of England, are they going to continue to raise rates? Possibly. Euro area said they're going to raise rates another 50 basis points in February and March. Does that help them bring down inflation? I don't know. Is our Fed raising? All we're doing is we're just slowing down the economy, right? We're raising rates. Now we're feeling the point like real estate's kind of unaffordable. Houses unaffordable. I read this interesting factoid that the median income in the U.S. and the median household price in the U.S. There's an old rule of thumb, like the rule. It's like a 30% rule. So never spend more than about 30% of your gross income on your house. And right now, the median income and the median home price, it would require that person to spend about 46% of their gross income. So clearly, we're still in an expensive zone right now for housing, which if anyone's seeing this phase right now in real estate, you're probably seeing a lot of build to rent. Any new developments, build to rent, build to rent. It's kind of depressing, but it's probably where the next 3 to 5 years are going. And I'm just curious if we have like home prices really insulated, or people aren't going to move because they can't pay 6-7% on their house. Anyway, I digress. But let's go back to pound dollar. Equal highs around 24. I like that short around 24, but a pretty tight stop. We are still wondering, I think the euro dollar, for example, between this 109 to 110 zone, where we actually hit highs around 109.20 this morning. I said the last couple of weeks, if we hit this 109 to 110 area on the euro dollar, I'm going to start looking for dollar strength. Right? So I think the euro's made this fantastic recovery. It's off of the lows by, I believe, 1,000 pips. From this low to this high, about 1,300 pips off the lows. We have more than retraced our 50% zone. All right, so a bit of equilibrium going on here. There's your 50% retracement, and I can see a nice little rejection for some short-term dollar strength, which may in fact mean that we have some risk-off trading, which is why I look at the SPX, which is why I look at the 410 on the SPY, and we're just looking to see where the big decisions are coming in. Oil prices, I had a chart alarm going off on oil for some recent highs. Oil trading at 82.22. And looking a little bit better to come back into this 200 EMA around 85. There's a yearly pivot on oil also sitting around 90, around $93, $94. So is this a low to high, low to high, low to high, like slow move to the 200 EMA, or do we get like a nice little breakout volatility move to the upside? I don't know. I'm not. I'd rather be buying oil down here on a kind of nice compressed coiled bullish pattern. But if it's just going to have these lows hold and it heads up, I think we can hit $90+. Does this become a problem? Oil prices were so high, it led to inflation last year. Well, is it a problem at $90? I don't know. We'll find out. Okay. All right. Gold and silver. Sure. Take a quick look. Gold. Think about gold and silver as counter crosses to the dollar. Okay. If gold is going to get stronger still, where does that take the dollar? If gold goes up, expect the dollar to go down. Okay. So if gold is going to retrace it all, I think the dollar gets stronger. It's essentially trading like a cross. If just take a screenshot of this or take a mental note of this. This is gold. Put in some lows. We've had a nice little rally to the upside. Flip that around and look at the dollar. We put in some highs. Yes, put in some highs, and we're going lower. It's almost the exact inverse correlated move to gold. So that being said, look at all these indecision prices for the last couple of weeks. A lot of indecision here on the dollar, right? What's interesting is we have not hit 350. Wow, Netflix is ripping to the upside. That's crazy, man. We have not hit the oversold condition yet on the DXY. I'm a little surprised, but if we have another flush to the downside, there's a weekly pivot down here where I put in right around 100. That's also around that weekly 200 EMA. And if we hit oversold conditions, I think the dollar is due for a little bit of a jump. And again, timing-wise, we have the Fed coming on Wednesday. Probability of the Fed raising rates, pretty high. But not as aggressive as they were back in 2022, right? 98.2% probability they're going to raise rates 25 basis points. February, raise rates once again in March. That's an 81% probability. We go into May, things kind of cool off. Stay the same. There's your pause. Right? So May, June, pause. And then the market's certainly going to be interested to see, do we hold rates higher for longer? Does the Fed cut rate by the end of the year? I don't know. Right? But I'm pretty certain that February, March is going to be a 25 basis points increase. Whether the market takes that in stride and moves higher or lower, I don't know. So I have to watch. Okay. BRK, is that Berkshire Hathaway? BRKR. Bruker? Ah, there you go. What do we have here? Medical specialties. I've not traded the stock. Let's see here. Interesting. Yeah, it looks good. Technically, it looks like a great pattern. I know that this is right on the verge of a breakout. Maybe a little bit more noise on this head and shoulders, though. We could pull back one more time into the 60s. or even pull back into the $60 zone. I think that, if it's offered, I'd like to see if that offers a pullback. Otherwise, it's a breakout. And stocks, when they break out, when stocks break out to the upside, especially in a head and shoulders or cup and handle, they tend to hold that pattern. So a break above here, that momentum, takes off. You can measure it. You got targets up there in the 80s. So good stuff. Yeah, I mean, right up here, that past support around 76. I like the area. A lot of lows back there at 76. So not a bad spot if we can, scoop up some low 60s, take it into the mid 70s. That's a pretty good move. Let's see here. If dollar goes up, will it be down versus the CAD? We can look at dollar CAD, which has been kind of a sloppy pair to trade. Honestly, I think the dollar CAD is a hard one to consider. Dollar CAD is kind of trash right now. It has not been a currency that I've really been able to feel out as far as directionally. It's been really choppy and sloppy. A couple of areas I like on dollar CAD will be back down here around 3,100 to 3,000. If this is high to low, lower high to higher low, we're forming a bit of a wedge right here. Oil is going to be a factor. The dollar index will be a factor, but I think that dollar CAD is still pretty well supported. I mean, if you think about this move here, all this support, even though it's been, really messy, we still have resistance, we still have support, and anything that comes back into the 1.31, 1.30 area, I could see dollar CAD going back up. So, what does that mean? Well, if that's dollar CAD strength, that means dollar stronger than CAD. So part of that could be, maybe the inflation, maybe the BOC is not raising rates along with the Fed. If I'm not mistaken, I think the BOC is sitting at 4.25%. Let's go to CB rates, but I don't know if they're looking to raise rates right alongside. So they had a rate decision December 7th. I'm not sure when the BOC is next. But if they raise rates again, like maybe they'll stay neck and neck, which is why the dollar CAD's also been pretty choppy. So I think, technically, if oil's going up, if we see oil at $90 to $95, that should naturally help the CAD. One pair that I'm in, Aussie CAD we've taken profit, New Zealand CAD we took profit. I'm long on CAD Swiss. CAD Swiss right here, sitting with some nice divergence on the daily time frame. We got a beautiful bounce off those lows at 68, and I'm looking to see if the dollar or the CAD Swiss can get back into these highs. There's a yearly pivot around 71.50. Nice little pocket between 71.50 and 7,200. So I'm trying to stay long and get some positive rollover on CAD Swiss. But that's more of a play against the Swiss than it is, CAD strength or weakness. Okay. I don't know if that answers your question, Craig, but dollar CAD's been a sloppy one. If it comes back to 1.31, 1.30, I think dollar CAD is a bullish trade, just based on what I see. So I got a couple more minutes here to wrap up. Flex Room will be busy this week, Tuesday, Wednesday, Thursday for some trading. We had a great discussion last week on Friday for Master Flex, so I'll be looking to dive into some of those filters we talked about. Let me see if I can bring up that screenshot from last week. So just a quick note, there's kind of 3 filters I'm looking to add into one of my robots. Hopefully something we can see a little bit more active trading through the week. And my intention is to do that for some of these prop trader accounts. We have a lot of students joining. Okay. Equities on Demand students, we had a crazy busy week last week, and it was great. If I just roll through our Telegram thread, we took a lot of profit. This was just all management from last week. All these trades right here. And the list goes on and on. So we had a lot of updates last week. Had some stocks called away for profit. Time to go right back in and get some more covered calls in, repair some of those trades, get a few more stocks called away. Look at some fresh trades. We've got some expirations out into February and March. We went out to April on a couple, but we'll just review everything today and start that in the next couple minutes. If you do me a favor, for everyone watching, we had like 65, 70 students watching live. We'll have probably 400 or 500 people watching this week, so fantastic. If you have any questions, I like how it's opening bell today. Not opening bell, my fault. Nice work on that, stupid. Has anybody traded opening bell before? It's my first time. Just kidding. Anyway, do me a favor, hit the thumbs up button for me. I'll switch it over so it's spelled correctly, and then we'll be back here on Friday to wrap up for the week. 9:30 a.m. Eastern time for the Pulver report. Apple is closing back up above highs, so we're getting this risk-on rally in right in front of the Fed. So it's just not a surprise. I think the markets just melt up, and we've said this is what the possibilities to start off the year. Market has the runway right now. No Fed until the 1st, and their language might be the make or break. I mean, just remember that the higher the market goes, this is what kind of the catch-22 is in the market right now. The market gets up here, and this is why I'm saying even with the Fed on February 1st, I don't know if the Fed is going to want to see the markets break higher. You know, I feel like their language is going to be like difficult enough, restrictive enough that this is that bull trap scenario. So just this is what we're going to talk about over the next couple weeks, especially going to that Fed rate decision. But in the interim, we could see this little melt up, and it's just a good spot to get a lot of profit. It's a good spot to get a lot of stuff called away, and it's good stuff to make some money. I mean, some risk appetite is here. We've had a nice little jump to kick off the year, but it is, you know, as I say, protect your profits. Okay. All right, everybody. I'll see you later this week for the Pulver Report. Tuesday, Wednesday, Thursday for Flex. All week, every day, every week for Equities on Demand. So I'll kick that session off just now. All right, buddy. Thanks a lot. See you soon. Bye.